Good afternoon, dear Dr. Schnabel, distinguished guests, ladies and gentlemen, dear colleagues and dear students. On behalf of the School of Economics and Management of the University of Cyprus, we are really very, very delighted that we have today with us Dr. Isabel Schnabel, an executive board member of the European Central Bank, who is going to present a very interesting and contemporary topic that affects all of us, the ECB's policies in order to meet problems and challenges faced by the COVID-19 pandemic. And we sincerely thank you, Dr. Schnabel, for accepting our invitation. It is indeed a great honor for us. A few words about Dr. Schnabel. Has been an executive board member of the European Central Bank since 2020, and she's responsible for market operations, and most importantly, she oversees whatever everybody knows, QE, quantitative easing, more than 2.6 trillion euro that you're taking care of, Dr. Schnabel. And Dr. Schnabel has been academic as well, a colleague of us in a way, at the University of Bonn, and she had other positions at the University of Mainz before that. And she has been a member of the German Council of Economic Experts. And we're very proud to see that among the best, not only in Germany as far as the financial economy is concerned, but in the whole Europe. We're very proud of you, and we're very, very lucky that we have you with us today. As I have already mentioned, the topic that Dr. Schnabel is going to present is very interesting, very, very contemporary. Unfortunately, this pandemic crisis affected all of us, not only as the whole nations. And unfortunately, last year, the whole global economy melted down by more than 3 trillion euro. That's a lot of money for only a single year. And European economy went down 4.5% during the last year. And the topic that Dr. Schnabel is going to present today relates to those issues and to the policies that have been implemented by the European Central Bank, mainly monetary policies, in order to mitigate or meet those problems and stabilize the European economy. Among those policies, we have the Pandemic Emergency Purchasing Program that was introduced by the European Central Bank, and there has been an extension as far as QE is concerned. Fortunately, projections in the global GDP, and hopefully it's going to take place. There are quite a few questions that I assume Dr. Schnabel is going to answer for us today. Among those, whether all those policies that were implemented by the European Central Bank, have they been successful or not? And if not, why? We always talk about crisis, but crises have opportunities. What should we do here in Cyprus or in Europe in order to take advantage of those opportunities, either as nations or as entrepreneurs? Today, we have with us several students, and students a lot of times are very pessimistic about the future. Can you provide to us some optimistic messages for our students as far as the future is concerned? Hopefully the future is going to be better. I would like to give you the opportunity right now for your speech, Dr. Schnabel. Thank you.
Thank you so much for your kind introductory words. And let me first share my screen. So now, let me see, somehow it disappeared. Can you see it? Can you see the presentation? Yes. Okay, excellent. So, yes. So thank you very much again. So it's such a pleasure to be with you virtually. But of course, let me say that it would have been an even greater pleasure to be in your beautiful country at your great university and to be with you and to see the people to whom I'm talking to. We were just discussing it before that, of course, it's always much more difficult to basically talk to a screen. And but I hope nevertheless that that you will enjoy my talk, and I'm very much looking forward to any questions that you may have in the end. And indeed, I'm going to talk about the ECB's policy response to the COVID-19 pandemic. And this first slide gives an overview of what happened on the macroeconomic side. So on the left-hand side, you see the evolution of real GDP, and all the graphs that I'm going to show to you today refer to the euro area, if not indicated otherwise. And I think you see here very nicely that that GDP collapsed dramatically in the spring of 2020 when we had the first lockdowns. But then the economy actually recovered very strongly as well. And if you just look at this first part of this yellow curve, it looks like a V-shaped recovery. But unfortunately, this V-shaped recovery did not continue up to this blue dashed line, which would have been the pre-crisis trend. But this recovery was interrupted by the second and then the third wave of the pandemic. And you can see that GDP fell again, but it fell much less than during the first lockdown. And it seems that there have been substantial learning effects. So the economies have learned to better deal with the lockdowns, which explains why GDP decreased much less in the second and third wave. And I think it's fair to say that now we are actually at a turning point. So if you look at any of the indicators that are coming in, like the PMI or other like confidence in, you see that they are all very strong and very optimistic, and they point towards a strong recovery this year. And you can also see this in our projections, which are shown by the blue line in the graph. And you can see that this year we expect there to be a rapid recovery, but you also see that GDP will not get back to the pre-crisis trend for a long time. So this means that the consequences of the pandemic will unfortunately be with us for quite some time. As a central bank, of course, we are most interested in what happens to inflation. This is shown on the right-hand side. So again, you see the yellow curve, which decreases very rapidly at the beginning of the pandemic. And this was partly driven by a sharp drop in oil prices, which happened at the beginning of the pandemic. And then there were other special effects, or for example, policy changes. So in Germany, which of course has a big weight in the euro area, there was a cut in the value-added tax, which then led to a decline in prices. And all this then led to an inflation rate that even became negative towards the end of last year. But then many of these effects reversed, and we see this sharp recovery in inflation. And as you probably know, the most recent reading of inflation, so the data for May 2021, are actually at 2%. And the inflation aim of the ECB is below but close to 2%. So in May, we were actually very close to that aim. And you can see that going forward, our models project that inflation is going to rise further. And this is due, among other things, to what is called base effects. So if you think, for example, about oil prices, we had this collapse in oil prices last year. So when we calculate inflation rates now, these refer to a very low starting value, are considered to be temporary factors. And therefore, as you can see very well in this graph, we actually expect a spike of inflation towards the end of this year, around 2.5% in the euro area. And then we again see a sharp decline. And in the medium term, and this is what matters for us most at the central bank, you can see that actually the price pressures are quite subdued, and that we go back to levels that are well below our inflation aim of below but close to And the main reason for this subdued inflation outlook is the existing slack in the labor market. So we know that unemployment is quite high, and we also know that many people are still in short-term work, and we cannot expect to see a sustainable increase in inflation until the labor market develops in a way that the price pressures that we are seeing in certain parts of the economy actually translate also into wage pressures. And we don't see that for now, and therefore our models show that the inflation outlook is actually quite subdued. So how did the central bank respond? Of course, the traditional instrument of central banks, and that is shown on the right-hand side of this slide, is interest rates. So normally you would expect that central banks would lower interest rates in response to an economic crisis. However, interest rates have already been lowered quite a bit, in particular after the global financial crisis of 2008 and 2009. The policy rates were lowered substantially, and at some point they reached what is called the zero lower bound. And then actually in 2014, the interest rates were even lowered below zero. So it was clear that there was nothing like a zero lower bound, but there still is something that people now call the effective lower bound, which means that central banks cannot lower inflation, cannot lower policy rates infinitely, simply because if let's say policy rates were lowered to levels of, I don't know, -2%, then probably many firms and households would prefer holding cash to holding their money on their bank accounts. And therefore there is a natural bound to how low interest rates can go. But then still you can ask, why is it the case that central banks have lowered interest rates so much? And in order to understand that, one has to look at the graph on the left-hand side. And here, this grayish area shows estimates of what is called the real equilibrium rate of interest. And this is the interest rate that balances the savings and the investments in an economy. And you can see that this interest rate has been trending downwards over the past decades. And this is the case not only in the euro area, but it's actually the case in all major advanced economies. And behind this, there are broad macroeconomic trends. So for example, we have economies that are aging. So demographic factors play an important role, because in aging societies, people tend to save a lot for old age. And so the desire to save is relatively high. On the other hand, we had this decline in productivity growth, which may partly explain why the demand for investment was actually comparably weak. And so a strong desire to save met a relatively weak desire to invest. And this is kind of an environment in which interest rates have to go down. I mean, even if you completely abstract from what the central bank does. And the central bank, in order to stimulate in the economy if inflation is too low, has to go below this equilibrium real interest rate in order to be able to stimulate the economy. And this is why the central banks were actually forced to lower rates so much. But now we have, I mean, we're not yet at the effective lower bound, but we have come closer to it, right? And this is the reason why central banks worldwide have started to shift to what is often called unconventional monetary policy measures. And you already mentioned the QE, and that's of course one of these unconventional tools. And if you want to know what the central bank does with respect to unconventional tools, the best thing is that you consider the central bank's balance sheet. And so on this graph, you see the ECB's, or more precisely, the Eurosystem's balance sheet. And you can see that actually this balance sheet grew quite substantially over time. And this was due to two types of measures. So the first type of measure in yellow and green are lending operations to banks. And I'm going to talk more about that, the LTROs and the TLTROs. And then you have QE, so the asset purchases. These are all the other colors. And you can see that after the outbreak of the pandemic, there has been another sharp expansion of the ECB's balance sheet due to these measures. And so this is QE on the one hand under the, as you already mentioned, the Pandemic Emergency Purchase Program, the PEP. And then there was a strong expansion also on the targeted long. So let me start with the PEP. So the PEP is a specific QE or asset purchase program that was tailored to the needs of the pandemic. So it's a bit different from our regular asset purchase program, the APP, in that it does not foresee like constant amount of purchases every month, but it defines an overall envelope, and this envelope can then be used relatively flexibly over time, across asset classes and across jurisdictions. And this is shown in these three graphs. On the left-hand side, you can see that the monthly purchase amount actually varied quite a bit over time. And naturally, the highest amounts, of course, were purchased at the beginning of the pandemic, at the time of the market turbulence. In the middle chart, you can see the composition of the asset purchases, private versus public. And you can see that the largest part, of course, is public sector securities. But in particular, in the early phase of the pandemic, at the time of the market turbulence, there were also quite a few private purchases, in particular, commercial paper purchases. But once market had calmed down, this was no longer necessary. And then finally, on the right-hand side, you see, at least for the four largest jurisdictions, you see the split across countries. And one very important characteristic of the PEP is that, I mean, normally our asset purchase programs are conducted according to capital key, so which is closely related to the relative size of the economies. But the PEP allowed for flexibility in the case that we observed fragmentation in financial markets. So in that case, it was possible to tilt our purchases towards particular member states. But interestingly, what you can see on this graph is that actually, I mean, it looks quite proportional, right? So you do not see many changes in the composition. And this is an indication that actually what really mattered was our commitment to this flexibility. But there was, in the end, given that markets knew that this flexibility was there was not so much of a need to actually use it. And I think that is actually very important. The second very important measures, and we should not forget them, are the TLTROs, the targeted longer-term refinancing operations. And these are liquidity operations for banks. So banks get liquidity, which they then ideally pass on to the real economy. And the T in this TLTRO is very important because it implies that banks get the most favorable rates only if they manage to hit a predefined lending performance threshold. So basically, these operations have an inbuilt incentive scheme for banks to keep on lending, and that is very important. And only if they hit the threshold, they get the most favorable rates. And these operations have been very successful. As you can see, the demand has been incredibly high. And there are now still two operations left in this year, in September and in December. Let me also briefly stress that in the pandemic, in particular in the early phase, there was not just the need for euro liquidity, but actually many market participants were in the need of US dollar liquidity, because the US dollar still plays a very important role in global financial markets. Therefore, at the beginning of the pandemic, the large global central banks, the Fed, the ECB, Bank of England, Bank of Canada, Bank of Japan, and the Swiss national banks agreed to reopen their swap line network, which basically meant that the Fed would be willing to provide US dollars to these central banks, which could then lend out these US dollars to their banks. And you can see that in the right-hand side graph, the take-up was actually quite large in the beginning of the pandemic. And then once the markets had calmed down, they actually went back to basically zero. And let me also stress that the ECB is running very similar schemes on the basis of euros with respect to central banks outside the euro area. So we offer euro liquidity to central banks outside the euro area on the basis of swap lines and repo lines. And all these measures, I mean, many of them are more like a backstop, and they're not even used very frequently. But as we know, such backstops can be very important in crisis times. So what were the effects of our measures? So this graph, I think, is quite impressive. It shows an indicator that we like to use a lot. It's called the KISS indicator, and it's an indicator of systemic stress in financial markets. And it's shown for the euro area and for the US. And what you can see on the left-hand side in this green little box is that the level of that indicator at the beginning of the pandemic was actually close to the levels that were obtained at the time of the euro area crisis, and not so far below the levels that were obtained at during the global financial crisis. And this tells us that financial systems at the beginning of last year were actually maybe closer to a financial crisis than many of us are aware of. And what you can then see on the right hand graph, which simply shows the same green box in an enlarged way, is that when the ECB announced the PEP, this indicator immediately went down, right? I mean, of course, it took some time for it to get back to pre-pandemic levels. Actually, what was incredibly important, in addition to monetary policy, was, of course, fiscal policy, which played an important role in the pandemic as well. And that was not just national fiscal policy, but as all of us are very well aware of, it was also the European package, which was very important. And the start of the negotiations, of course, came with this French-German recovery fund proposal, which then in the end merged into the next generation EU. And I think it's hard to overemphasize the importance of the next generation EU also for financial markets. So I think it's important to stress that in this pandemic, monetary policy and fiscal policy truly worked hand in hand and reinforced each other, which increased the effectiveness of both types of policies. And this was incredibly important and very different from the experience that we've had in previous crises. So what you can see on this slide is that if you look at the left-hand side, so this shows if you want the euro area yield curve. Of course, there is no such thing as a euro area bond yield curve, but this is simply a GDP-weighted average of the national yield curves, and that is an indicator that we use very often. And what you can see is that this curve shifted up quite strongly at the beginning of the pandemic. So that is the shift from the blue curve to the green curve, which means there was a substantial tightening in financing conditions at the beginning of the pandemic. So that was, of course, the opposite of what was needed in order to stabilize the economy. And our measures then helped to push this curve back down. And actually, there were times when it was even below the pre-pandemic levels. And now it has actually shifted up again a bit because of the ongoing recovery. Then if you look at the right-hand side, this shows the spread of selected government bonds relative to the German Bund. So we show Portugal, Spain, Italy, Greece, and of course Cyprus. And it's very interesting to see what happened at the beginning of the pandemic. So you can see that really the sovereign spreads towards the German Bund, they basically shot up. And we saw something that we had seen before, namely in the euro area crisis, namely dramatic fragmentation in financial markets, which where the yields of some government bonds went up much more quickly than others. Actually, the German Bund even decreased because it was considered a safe haven. And that, of course, for the ECB was of great concern, because it means that our monetary policy no longer reaches the entire euro area to the same degree. And you can also see that the spreads went down quite strongly when the PEP was announced. So that was very successful. But then it still stayed at an elevated level. And I think it's fair to say that only with the European fiscal package, we then actually managed to bring the spreads down to pre-crisis level. So again, it was the combination of monetary and fiscal policy, which played a very important role. So overall, and you can see this on the left-hand slide, the financing conditions in the euro area eased due to the ECB's measures. And what you can see on the right-hand side is that there was a sharp jump in bank lending to corporates in the spring of 2020. And that was incredibly important for the economic development, because you have to remember that that was a time of the first lockdowns when many firms saw their revenues collapse suddenly. But of course, they still had to pay their bills and to finance their running costs. And so they were really reliant on their banks giving them loans. And due to the monetary policy measures on the one side and the fiscal measures on the other side, and particularly the loan guarantees, the banks were willing to grant such loans. And that really was very important in the early phase of the pandemic. So this slide now shows our estimates of the impact of our monetary policy measures on inflation and on real GDP growth. And you can see that according to our estimates, our measures have a substantial positive effect both on inflation and on real GDP growth. And of course, again, fiscal policy played a very important role as well. And on the right-hand side, you can see I mean, it shows the confidence indicators, and you can see that we are now facing a sharp recovery, but that this recovery is uneven. So it differs across sectors. And I think this is something that especially Cyprus is very well aware of, namely that some sectors were hit much more strongly than others. And of course, the services sector was hit much more strongly by the lockdowns than the manufacturing sector. And in particular, tourism was hit very strongly. And the heterogeneity at the sectoral level, of course, also translated into a heterogeneity at the country level. I already several times mentioned fiscal policy, and I would like to stress that fiscal policy was very important also in cushioning the impact of the pandemic on the labor market. So on the left-hand side, if you look at these little green diamonds, they show the unemployment rate in February 2020. And then the blue bar shows the unemployment rate in April 21. And you can actually see that the difference is not all that large. However, you also see the yellow bars, and this is the share of workers in job retention schemes or short-term working schemes. And this is actually a large share. And so you can imagine what would have happened to the unemployment rate if these schemes had not been there. But of course, given all these very strong fiscal measures, we also see on the right-hand side that public debt ratios have gone up quite substantially. And again, we see some heterogeneity there, with, of course, the countries that were hit more severely by the pandemic also show somewhat higher increases in public debt ratios. And in addition, of course, there was already quite some heterogeneity to begin with. I think it's important to stress, however, that there was not really an alternative to this strong fiscal action. So imagine this strong fiscal action had not taken place, and monetary policy would again have been the only game in town. My prediction would be that this would have led to even higher public debt ratios, simply due to the fact that GDP would have developed so much worse than it actually has. So I think it was necessary, and there was not really an alternative to these strong fiscal measures. But of course, it may raise some concerns going forward. let me say a few words about the equity market. So equity markets have risen quite substantially, and I think the graph on the left-hand side is interesting in that it shows that in the past month, the increase of stock prices has to a very large extent been driven by these dark blue bars. And the dark blue bars, these are the longer term earnings growth expectations. So the strong increase in stock prices was related to improved longer term earnings expectations, which is very important. Some people are worried about potential overvaluations in equity markets, and on the right-hand side, you see a measure of such overvaluation, the CAPE ratio, so the cyclically adjusted price to earnings ratio. And what I want to show on this graph is that if you look at the US, this indicator is actually quite high. So it's much higher than it was at the time of the global financial crisis, and almost as high as it was in the dot-com crisis. But the same is not true for the euro area, where the development is much more contained. And let me now come to the topic that is probably the most discussed topic going forward. There is all this debate in the US, but also in the euro area and elsewhere. So what is going to happen to inflation? And you remember the second graph that I showed to you today, that in the models, it's very clear that there will be this spike in inflation, but that this is going to be temporary, and that the medium-term outlook is going to be subdued due to developments in the labor market. But there is, of course, some discussion going on. And one aspect that is discussed a lot, and this is shown on the right-hand side, is the strong increase in commodity prices that we've seen. So this is oil, this shows copper, metals, and lumber. And you see that the price increases have been very substantial, and that this has gone beyond the normalization of the decline that we've seen at the beginning of the pandemic. And this, of course, has also led, among other things, like the bottlenecks that we've seen in the global economy, the supply chain disruption. This has led to a sharp increase in producer price inflation. This is shown on the left-hand side graph. And I think, these increases are, of course, quite impressive. And this now raises two important questions. So the first is the increase in the commodity prices potentially just temporary or not? And I think lumber is very interesting. So it's discussed a lot in the markets, because what you see there is that there was, an increase of the price by a factor of 4, which is, of course, quite dramatic. But then you also see that at the time when the economy reopened, there was always a sharp decline in prices. And in particular, most recently, you see that prices of lumber have halved. And I think lumber is a very good example, because there was a high demand for lumber at the time of lockdowns, when many people were starting to rebuild their houses and so on. So there was this sharp increase, but this may actually be something that is temporary. And on the other hand, and this is shown on the left-hand side graph, there is this question about the pass-through of producer prices to consumer prices. So what we've seen before the pandemic very often is that these increases in costs were not transmitted to the consumers, but were rather absorbed by the company's profit margins. And it is an open question on whether the same is going to happen now in the face of weakened balance sheets of the firms and very strong demand on the side of consumers. So that will be very interesting to see whether we are going to see a stronger path through now than we have seen in earlier times. And this is now my final slide, which shows what has happened to inflation expectations. And what you can see here is that, so this is derived from option prices. So if you look at the green area, so this is this is the probability of an inflation that is above 2%, so above our aim. And you can see that the green area has increased in recent months. But of course, it is still relatively small. So it's like it has a level of 25%. The risk of deflation, so the red area, has basically disappeared. But what we, of course, would like to know, what is going to happen going forward? Is this trend going to continue or not? And this is what is relevant for us as central banks. And I think there's a lot of uncertainty now on regarding what is going to happen. But as I said, one factor that is absolutely key is what is going to happen in the labor market. And then on the right-hand side, there's another factor that creates a lot of uncertainty, and this is the accumulated savings. So in the past 1 and almost a half years, many people were not able to consume as much as they would have liked to consume. So there were there were forced savings, and actually many people have accumulated high levels of savings over time beyond what they would have normally saved. And it is now a very interesting question of what is going to happen with all these savings. And this will have a strong impact on the economy going forward. If a large share of this is going to be used quickly, this would mean that economic growth could be stronger than we project. But if very little of this is used, the situation is very different. So you can see there's a lot of uncertainty about the outlook going forward, and this is what keeps us busy at the ECB. And so let me stop here, and I thank you so much for your attention. I'm very much looking forward to your questions.
Thank you very, very much, Dr. Schnabel, for the very, very interesting and insightful presentation. Indeed, great presentation. Thank you very much. Let me give the opportunity right now to our guests for any questions. You can raise any questions you would like to. You can raise your hand, or you can write your questions on the chat. Okay? So any questions? Let's start with Stavros. Okay, so remember to raise your hand or add your question on the chat. Stavros.
Isabel, first, thank you very much. It's great to have you here. And now we have you in the department. I have a very long list of questions I would like to ask you, but I will ask only two. One is a quick one. I think your second slide, you show inflation expectations going to 2.5 and then reversing. And I'm wondering, what kind of model do you have that shows this sudden reversal? I mean, how much confidence do you have that it will reverse in 2022? I hope this slide does not come back to haunt you. The second question is more kind of fundamental. You seem very pleased that there was this collaboration with the fiscal authorities. So the central bank was not left the only game in town. And you explained the reasons. This is very nice. Do you think you expect to see this kind of collaboration when it comes to climate risk? Because that's another major external shock. So in the external shock of the pandemic, the fiscal authorities did their part, and of course the central bank did its part. Do you perceive that the climate risk is another external shock where you could see this joint effort? Thanks for being with us.
Yeah. So thank you very much, Stavros. These are two excellent questions. So on the first question, so the models don't give you the full story. So you need to take into account specific factors. So I mean, for example, the policy reversals that we are seeing, I mean, they have to be added to the models in order to be considered. Part of it is simply base effects. So that is really something that automatically happens. And then, of course, there are assumptions that you may question, of course, which are related to what I mentioned only very briefly, which are these bottlenecks and so on. So, I mean, what we are facing currently is that the reopening is happening probably a bit more quickly than many expected. So you get suddenly very strong demand. And on the other hand, you have supply that is not fully flexible. And this leads to certain price pressures. And the assumption that we have built into our models is that these bottlenecks are going to resolve within the course of the year. But you can, of course, have some doubts. I mean, I know that there is a lot of discussion about the microchips, for example, where it's not so clear that all of this is going to disappear already this year. On the other hand, you see, I mean, I had this, I mean, the lumber example. So there are things that disappear relatively quickly. But I mean, you said it very nicely. You hope that the models won't haunt us. I think we have to be a bit careful with the models, because the models, of course, they rely on historical data. And I mean, in the historical data, you always had the situation that inflation was very low at the end, right? And so this is built into the models, and whether this will be the same going forward, I mean, we don't know precisely. So, I mean, it could be that we are now facing a kind of structural break, which then means that history is maybe not a good guide to what happens going forward. And this is the reason why we have to be very careful, and we cannot merely rely on the models, but we have to look around and watch these things very carefully. And then the second question, so I probably wouldn't say, and I hope I didn't say it, that we collaborated with fiscal policy. Normally I say we complement each other. Because of course we are an independent central bank, and so we don't collaborate with fiscal. And actually, I think that's also the question, the answer to your second question. And I think it's, I'm very happy that you raised this topic of climate change, because I mean, I always say, I mean, we are all so shocked by the pandemic, but climate change is a much bigger threat. So it's still, I mean, even though we think this is already a terrible crisis, but this is still a completely different dimension. And so I think we have to take it extremely seriously. I mean, of course, and we have always stressed that in the area of climate change, fiscal policy will be the main actor, will have to be the main actor. And they have, in the end, the governments have to do the job. But I also always very strongly argued that we cannot simply stand on the sidelines and just wait until governments do their job, but we have to try to facilitate the transition to the carbon-free economy, simply because the financial market plays such an important role in that transition, and we are such an important player in financial markets. And in that sense, you could say that this is another area where we need to complement each other. Sorry for the long answer.
Okay, thank you very much. A question by Luis Christofidis, our ex-dean of our school. Luis.
Thank you very much for a very interesting presentation. You had a graph of the GDP-weighted yield curve and the impact on this of the PEP program, showing a parallel shift down. Now, in both cases, the slope was strongly positive, and I wanted to ask whether you interpret this as being, as it's indicating an expectation, a market expectation that interest rates would rise in the future. And if so, what forces you would attribute this increase to? Thank you.
Okay, so that's a very good question. So let me say first that, I mean, what I showed to you, of course, is simply descriptive statistics, right? So it's not a causal analysis, right? So that was just, I was just showing you the yield curve in different points at different points in time. So this is not really a causal analysis. For that one would need a model, and this was just data. I mean, of course, there is the expectation that interest rates, I mean, hopefully there's the expectation that interest rates at some point are going to go up. If that was not the case, I think the outlook would be very dark. I mean, of course, we all hope that at some point the economy will be strong enough so that interest rates will go up, and this seems to be also the expectation in the market. I mean, of course, you know that we have a very strong forward guidance on short-term interest rates, which means that short-term interest rates are going to stay low for quite a substantial period of time. But if there is, of course, a recovery, we would expect, and you already see that very strongly in the US at the moment, you would, of course, expect the longer rates to go up, reflecting the expected recovery. I hope that answers your question.
Okay, thank you very much. Our colleague, Professor of Economics, Marios Zachariadis.
Hi, I enjoyed your talk. A couple of questions, somewhat related.
Marios, we cannot hear you that well.
Can you hear me? Hello?
Yes.
Yeah, so try. I would try to understand what you're saying.
Yes. So a couple of questions. The first one relates to persistently low interest rates. And just your comment on the concern that these might actually hurt the quality of investment and long-term economic growth and productivity growth prospects. So that's one. And then the second related question is, even though everything that has been done pretty much in Europe and elsewhere was essential to rescue entrepreneurs and workers, whether there is a concern that there would be a point where doing a little bit too much of that would actually end up rescuing firms that are rigid to change because something has changed or change has been accelerated and somewhat supporting these more rigid firms would actually again end up hurting down the road in terms of bankruptcies, but also in terms of productivity growth. Thank you.
Okay. Thank you, Marios.
Yes, thank you very much. So, so I'm not entirely sure whether I understood the first question. I assume that is related to all this debate about what people call the zombie companies, right? So that, or maybe, or otherwise you rephrase the question maybe again.
So undertaking low quality investment projects because of cheap money, that's the concern.
Yes, so that's actually exactly that that debate. I mean, I think this is a very important debate, and it's actually related also to your second question, right? I think this debate is less relevant in the context of the pandemic. I mean, at least the first part of your first question, because I think here it's very clear that that many companies that were running into trouble were not running into trouble because they had a viability problem, but simply because they could no longer sell their goods, right, or their services. And so I think, even though I take this concern very seriously, I think in this particular episode, it was extremely important to bridge the time of the pandemic in order to avoid that companies go into insolvency that are in principle viable. But of course, I perfectly see your concern that this may also at some point be too much, and that we may actually keep firms alive that that maybe should go into insolvency, thereby delaying the structural change that is clearly needed. Because I think it's quite obvious that we will not get back to the pre-pandemic economy. So actually many things have changed, and there will be structural change, and certain sectors will benefit, but other sectors are going to suffer. And those sectors may actually afterwards have a kind of a smaller capacity than we had before the pandemic. And therefore, I think it's very important, and this is mostly, of course, now directed at governments, that the support over time becomes more targeted, and that governments make sure that only those companies are supported that actually have a chance to survive afterwards. Otherwise, I think you're right that this could delay structural change, and in the end, lower productivity and lower economic growth, and that would, of course, be detrimental.
Okay, thank you very much, Dr. Schnabel. Barrett Kubelian.
Hi there. I've got a couple of questions I'd like to take your view on. The first one is, whether the ECB or yourself have seen any changes to overall productivity levels as a result of the, potentially the new ways of working that we've been seeing, whether anecdotally or through the actual figures coming through. And then the second one is more of a medium-term question. What is it that excites you about the Eurozone's prospects, opportunities in the future, upside surprises? What do you think those are in your view?
Okay, very, very good questions. So on the first one, I'm afraid I don't have any evidence yet. I mean, I probably, if I check with the people in our economics or research department, they may have something. But I think this is a very interesting question to look at. I mean, if we look around and kind of collect anecdotal evidence, it seems that there could be quite substantial productivity effects. But I believe it's a bit too early to tell, but this will be a fascinating research area going forward. I mean, what I see is that, of course, very few people will continue to work precisely as we now did during the pandemic, with more or less 100% teleworking. But what is also clear is that many firms switch to more flexible working modes. And I mean, at the very least, of course, that I think that should increase the well-being of employees, because this flexibility, I think, has a value, in particular for people who also, I mean, I don't know, who have children, small children, sick parents, whatever. But the effect on productivity will have to be observed. So I cannot tell you any hard evidence on that. On the euro area prospects, that's of course very much related to what Andreas said at the very beginning, that what could be a reason for optimism. And so I would say that that what was achieved at European level in this pandemic is actually quite remarkable. I think if I would have asked any of you before the pandemic whether we would get a next generation EU, you would probably have said no, not in the next 10, 20 years, right? But this has happened. And I think this is very encouraging, because it shows there is a strong commitment to Europe, to the euro area, or to the European Union. And even though, of course, so far this is just a one-off program, I think if it works well, it opens up the way to more integration, which I think is badly needed, and which would strengthen the euro area substantially. So I believe that the benefits of integration have not been exhausted at all. I think there are so many things which could still be done, and basically in almost all areas, in some more than in others. And I think this so there is a lot of potential to further strengthen the euro area and the European Union through further integration. And this is what makes me optimistic.
Thanks a lot, Isabel. Andreas Melidonis, our colleague, professor of finance at the University of Cyprus.
Hi, Isabel. Thank you very much for your speech. It was great hearing you. Hopefully we'll have you with us sometime soon. I have two questions for you. One is related to your presentation, and the other one is a bit more general. I'm going to focus more on the banking sector, though. So the first question is, should we expect a different treatment of non-performing loans that took place before COVID and after COVID, given that COVID is, let's say, a unique shock to the system? And the second question has to do with anti-money laundering policies. Could you describe the ECB's role in AML policies, and if this is expected to change in the near future? Thank you.
So thank you very much for those questions. so unfortunately, I have to tell you that I'm not responsible to any of those two questions. I will, because both are not, I mean, so we have, as you know, we have a clear separation in the institution between the central banking side and the supervisory side. I mean, of course, nevertheless, I can tell you a bit my view, but of course, the SSM is separate from the central banking side. And I mean, I know there is this discussion ongoing. I mean, my prediction will be that there will not be such a distinction between the NPLs before and after COVID, because it's very hard to say whether, I mean, those NPLs that we have in the pandemic, whether this is actually due to the pandemic or whether this is due to weaknesses that existed already before the pandemic. And but I cannot tell you what my supervisory colleagues would say. So you would have to ask them, because I'm not responsible for that. And the same is actually true for any anti-money laundering, which is an enormously important topic. But it's not the ECB that is responsible for that. So that is not within our mandate. And we have always argued that we need much better controls against money laundering, and that this should be done at a European level, but it's not within our mandate.
Okay, thanks a lot, Isabel. We have Andreas Aschotis, a banker from Hellenic Bank, right, Andreas?
Hi. Hi, Andreas, and hi, Isabel. Thank you very much for a very interesting presentation and the feedback you have provided to the rest of the colleagues. I have two questions, but I'm happy with the answer that you gave with regards to the NPLs. A spot-on question by Andreas Milidonis, but at the same time, because of the way that NPLs are behaving here in Cyprus, then it's good not to give wrong messages, I think, for borrowers to find ways not to pay. Now, the first question that I have relates to the discussion of inflation and the temporary or transitory impact that we might see. But before really seeing that, the ECB is undertaking a strategic review. So is it part of the mandate to also reassess the consumer price index with the relevant weights? Does it represent the true cost of what consumers face today? That's the first one. And the second one, I would like to ask if you can provide any insights on the potential construction of a European bad bank. It has been discussed by Mr. Enria back in December. So it was a tool that, as he mentioned, so if you have any feedback, it would be very good to hear from you. Thank you for the presentation.
Thank you very much for those questions. So it seems that that Andreas is a very frequent name in Cyprus. Is that true, or is that just an accident?
Yes, it's the common name here on the island.
Okay, very interesting. Okay, so on the question regarding the strategy review and the consumer price index, I mean, as you know, of course, we have not yet finalized the strategy review. So, of course, I cannot tell you anything about the outcomes of the review. But what I can tell you is that, of course, for governance reasons, it is very important that the index that we are looking at is not constructed by ourselves. But this is an index that is constructed by Eurostat, so the European Statistical Authority, of course, in close collaboration with the national statistical authorities. And this means that if it comes to changing the inflation index, what we can do is to contact Eurostat and explain to them why it may be useful to change the index. But in the end, it's Eurostat that has to do it. And I think from a governance perspective, that is exactly right. I think overall, the HICP, so the harmonized index of consumer prices, is not all that bad, but it has certain weaknesses. And I think the major weakness that we have is that it does not sufficiently take into account the costs of owner-occupied housing. So so rents are included, but what is not included is are the costs if someone lives in a house that he or she owns. And this is something, as you probably know, that we are looking at very carefully also in the review, because this is a shortcoming of the index, which also matters quantitatively. So on the bad bank, I'm afraid I again have to say that this is outside of the scope of my activities. I mean, of course, this is a project that Andrea and Ria has pushed quite a bit. I mean, the reaction to it at European level is not everywhere enthusiastic, I should probably say. So I don't have the feeling that this has a lot of momentum at the moment, but let's see. I mean, there are good arguments to have such a construction, but the political debate on that is certainly not easy.
Thanks a lot, Isabel. Sofronis Skliridis, Professor of Economics and Chairman of the Department of Economics at the Institute, has a question. Sofronis.
Thank you, Isabel. Thanks for being with us. My question is also about inflation, actually, so it kind of fits in with the last one, but it's a little more philosophical, maybe. So we know, I mean, the ECB has long had this target of this somewhat cryptic target of below but close to 2%, which basically implies an asymmetric loss function, if I can put it that way, which is pretty consistent with empirical observation, I would say. Which is, you know, this is different from what the Fed does, for example, which has a more symmetric approach, and different also from what the Fed has done recently, which has introduced even more flexibility by taking kind of a more long-term average measure of inflation. So are there any thoughts, is the ECB sort of considering how it sets its inflation target?
Yes, so thank you for the question. I mean, you can probably imagine that this is one of the main topics that we are, of course, debating in the strategy review. And I think we have to be aware of the fact that this, as you say, is somewhat cryptic aim, inflation aim, like that formulation. I mean, that was developed already in 2003. So that's a long time ago. And of course, that was a situation that was very different from today. I mean, at that time, the main concern was inflation being too high. And at that time, it was not really conceivable that we would get into a period where the main concern was that inflation is actually too low, which then constrains monetary policy quite substantially. In our introductory statement to the press conference, there has been for some time now a commitment to symmetry. But this is certainly something that we are discussing in the review, and that may have to be clarified going forward in order to make clear that the 2% is really symmetric and is not to be considered as a ceiling, which the current formulation may somehow suggest. It's a different question whether one actually wants to move to an approach like the one that the Fed has, which is a flexible average inflation targeting approach, because this is more than saying that the aim is symmetric. It basically says that if you had shortfalls in the past, that you want to make up for that in going forward. And so this is much stronger than saying that the aim is symmetric. And this is also something that we are, of course, debating. And I'm afraid you will have to be patient to see what comes out of that very intensive discussion.
Thanks a lot, Isabel. We have some questions on the chat. We have a question by Mr. Kyriakidis. Kyriakidis says that he found the presentation very interesting. He sincerely thanks you for that. He has a question about PEP and the effect of PEP on yield spreads, and also the effect of QE on yield spreads. And he's asking the question whether you expect the yield spreads to go up after the PEP or QE is going to be over. And he's asking what policies ECB is thinking of introducing to maintain stability between North and South, North Germany and the other countries, and South, all those countries that you mentioned earlier, Cyprus, Greece, Spain, Italy, Portugal, and all this stuff. Very interesting question.
Yeah, indeed. Indeed, it's a very important question. So of course, I told you that in the pandemic, the flexibility of the PEP was very important in order to deal with this issue of potential fragmentation. I think going forward, this is one of the main questions that has to be answered when we discuss at some point what's going to come after PEP, because a PEP is of course a program that is closely linked to the pandemic, and so it's also in that sense it's very different from our other purchase program, the APP, which for now is an open-ended program. So as long as we are so far from our inflation aim, we basically gave the forward guidance that we're going to stick to it. And but there is, of course, the danger that such periods of fragmentation may appear again, and we have to think very carefully how to deal with that. But there is no a decision on such things now. I mean, of course, this discussion was there before, and also before there was an instrument that was invented to deal with issues, which was the OMT, right? The famous whatever it takes. But that program was, in a sense, very different from what we have now, because the OMT program was subject to a very strong conditionality, and it was linked to ESM programs. And it was also, of course, very different in the sense that it was actually directed at individual countries facing problems, while we are now talking about like general phenomena of fragmentation that could appear. And I mean, in the end, of course, let's say the longer term solution, I think, cannot be monetary policy. The longer term solution has to be has to come from fiscal policy, and this is also what I was referring to that we need a more stable architecture in the euro area. That in the end we do need some type of fiscal capacity, which can also help to deal with asymmetric shocks. I don't think that in the longer term this is a problem that can be solved by monetary policy alone.
Okay, thanks a lot, Isabel. We have another question by Mr. Lukis Kaliotis. He said that you were skeptical about the flexible targeting regime that was advocated by the Fed, where inflation rates are higher than targeted. And he's raising the question, if you do believe that inflation targeting is indeed problematic, do you see any other alternative ways as far as interest rate management is concerned? And another question, because we're running out of time, and it's by Chris Ignatiadis. He said in one of your slides, you mentioned public debt goes up, And he's suggesting, discussing that or showing also net debt, excluding cash reserves. Because he says in Cyprus, cash reserves are about 17%.
Okay, so thank you very much for those questions. So on the, and it's related to the question that we had before. So the question whether it would be advisable that the ECB follows an approach that is similar to that of the Fed. I mean, I think it's very interesting actually to observe what is happening at the Fed at the moment. And I mean, we have, of course, we cannot say yet whether in the end we will say the Fed had precisely the right strategy, or whether we will say, oh, you see that this strategy also has some shortcomings. So let me say first, from the theoretical perspective, of course, the whole approach of average inflation targeting relies very much on this expectations channel. And you have to make very specific assumptions on expectations, so agents have to be very forward-looking and so on, for this whole strategy to work. And I would say our understanding of inflation expectations is actually pretty poor. I mean, depending on what you look at, I mean, market-based inflation expectations, household inflation expectations, firms inflation expectations, you get very different results. So I think we may sometimes, put too much reliance on these type of models, even though expectation formation in reality may look quite different. The second point is that I mean, in the current situation, it's actually quite tricky to have this strategy that the Fed has, because it also it relies on the idea that that monetary policy should be much more patient for a while in order to re-anchor inflation expectations. But then once there is the lift off, we can respond very rapidly. And so if inflation then goes up, we can respond very rapidly. And there is this idea that we have a problem coming from the lower bound, but there's not really a problem if inflation becomes too high. And there I'm a bit skeptical. So I think there is a danger that such an approach becomes pro-cyclical, that inflation, especially in a situation as we're seeing now in the US, actually increases more quickly than thought. And then, I mean, it's the question is whether it will actually be possible to raise rates as quickly as would be needed. And I think it's not easy. I mean, given the stock market valuations and so on, it's probably not so easy as in the models to then adjust policies in the other direction.
Okay, thanks a lot, Isabel. Two last questions from the chat. One is from Dr. Petros Kareklas, a very good friend of us, mayor of Kythrea. And the other one is from Evangelos Makris. Dr. Kareklas says ECB has been very generous with regards to relaxing issues related to public debt, and I assume also NPLs. Will you be so generous if pandemic, is going to continue in the longer run or during the winter? And the last question by Mr. Makris, he's talking about the technical analysis that you presented and how much difference the decision-making processes at the political level of the European Central Bank.
Okay, thank you very much. So on the first question, I assume that what is meant by generosity is our monetary policy measures. And if this is what is meant, I'm not entirely sure. Then, I mean, we are guided by our mandate. And if the situation becomes very bad again in the fall due to the Delta variant or other variants, I mean, of course, we will respond again with the same force as we did before. There can be no doubt. And we hope, of course, that that is not needed and that we are on the path to recovery. But we are, of course, aware of the fact that there are downside risks, and if needed, the ECB will, of course, be there as it was there during the pandemic so far. So I think that is, if that is the point, at the point of the question. On the second point, I'm not sure I understand. Andreas, can you translate that question to me? Do you understand what the actual question is? I'm not.
I wasn't sure about the question raised by Macris. He talked about technical analysis and how this technical analysis can affect decision making in general.
Okay, so maybe let me interpret the question as I understand it. So I think you would be very surprised if you ever attended a meeting of the Governing Council of the ECB, because this in large part, it's really like an economics seminar. So we have many highly technical presentation, and also the discussion is very much based on arguments also coming from the academic literature. And the discussions are actually at a very high technical level. I mean, of course, there's always a point when it becomes a bit more political, but I still think the discussion is very much influenced by this more technical analysis, which of course is also provided by the staff of the ECB, but also of the entire Euro system, and this forms the basis of our decisions.
Thanks a lot, Isabel. We have the last question by Dr. George Sirijas. He has been in the past for several years at the Central Bank of Cyprus as an executive, and also executive member of the board of directors of the Central Bank of Cyprus. And right now he's working for the research center at the University of Cyprus. Yorgos?
Thank you, Andrea. Thank you, Isabel, for a very interesting presentation. Let me ask you this. In the previous crisis, it was characterized by a premature exit of the fiscal policy, and the monetary policy was left alone to save the day in the euro. This time around, the fiscal policy is set to be with us at least for some time. And if we look at the EU next generation, money is going to be at 2026, even longer. And the real concern is that we can envisage a scenario that we have a tightening of a monetary policy, whereas at the same time we have an expansionary fiscal mode. Do you envisage such a scenario? This is the first question. And the other one is since on the pandemic program, you praise the flexibility of that program of keeping the spreads down. Why don't we make a permanent feature this flexibility? And as you rightly said, you didn't have to use it just by having it there. Having this flexibility in the collateral framework in order to address disparities, regional disparities, and keeping the spreads down, so to prevent the previous crisis that we have, that it was a regional sovereign crisis. Thank you, Isabel.
So thank you very much for two excellent questions. So on the first question, I think that every policymaker is very much aware that the worst thing that can happen is that the support is ended prematurely. And I mean, I can assure you that on the monetary policy side, we will do everything to avoid that. So we will make sure that we do not kind of choke the recovery. I mean, on the fiscal side, I think the discussion will be intense. And I mean, you seem to be worried more about monetary policy. Maybe we should be worried more about fiscal policy, because of course, in some countries, we do see that there is already a debate ongoing about consolidation of public finances and so on, which may actually be come a bit too early. And I think I'm very happy, and you also mentioned that we have the next generation EU. And actually, I think, I mean, many people said at some point that this is coming very late. I think it actually comes precisely at the right time, because this is a time when there will be discussions about, you know, being less expansionary on the fiscal side at national level, but then we still have the support from the European level, which I think is extremely important. But I hope very much that we take the lessons from the previous crises seriously, and that that there will not be a premature exit from crisis measures. On the PEP, or on the flexibility, I think that is actually not an easy issue, and we don't have a solution to that. I mean, you should of course be aware that we are bound, of course, by the treaty, and there is of course a prohibition of monetary financing of governments, and of course this is something that we have to take very seriously. And I mean, the reason why the PEP could be so flexible was also that it was said that the pandemic really did not give rise in any way to moral hazard problems. So one could easily say that that the damage that the pandemic caused for many countries, that was not self-inflicted in any way, but it was just, let's say, bad luck that some countries were hit more strongly than others. I mean, going forward, I guess this question of the moral hazard will play a more important role. Of course, there is this idea, believe it or not, that that the market also sends important signals which have an impact on governments' behavior, and I think it would probably not be possible to, to suppress, and also not optimal to suppress these signals altogether, let's say forever. That would probably not be feasible. And therefore, it's not that simple. We cannot simply transfer the full flexibility of the PEP to other programs. But we will have to think about this question very carefully, because of course I understand the concern that is behind your question. And the ECB certainly has a strong interest in preventing fragmentation and in making sure that the transmission actually works to the entire euro area. And but it's also again a bit related to this question on the architecture of the euro area, and that fiscal policy will have to play a role in that.
Thanks a lot, Isabel, for the great presentation. Indeed, we really enjoyed that presentation. And let us hope that the policies that have been undertaken by the European Central Bank are going to be effective and mitigate problems, and also maintain financial stability in Europe. And let us hope there's going to be more equality between North and South. That's what we want, all of us, being at the southern part of Europe. I would like to also sincerely thank all our participants and for the excellent questions and for the great answers that you provided to all of us. And as we have already talked at the beginning of this presentation, you visited Cyprus twice so far, only for a very, very short period of time, you mentioned, right? A day or so. We promise when the pandemic is going to be over, we're going to have you here in Cyprus for face-to-face presentation. So we're going to meet you in person, and also you can deliver a speech to all of us here. Once again, thank you very, very much.
So let me tell you, it was such a pleasure to be with you, and I very much enjoyed the discussion. These were really excellent and to the point question, and it was a great pleasure.
Okay, thanks a lot, Isabel. Let's keep in touch. Okay, yes. Thank you very much.
Bye-bye. Thank you so much.
Thank you.
Thank you, Isabel. Thank you.